let's say you're looking for a home and your monthly budget is $3,000, which I think is already a bit of a stretch. I don't know. That sounds like a lot if you ask me. But Redfin says you can only afford a house. I don't like that word only, with a price tag of $429,000. And that's assuming a 30-year mortgage with an interest rate of 7.3%. Now, you've lost $71,000 in purchasing power in 1 year, as your $3,000 budget would have gotten you a home of $500,000 last year, because that mortgage, that 30-year mortgage, would have been at 5.5%. So you go all the way back. Now, this is the hard part. You go all the way back to December of 2020, and you could have bought a house purchase at $629,000. That would have been the purchase price. That's 200 grand. I think this is a great example of what interest rate hikes can do to the consumer and our economy. Now, the hikes have destroyed your purchasing power. But look at it from even a seller's perspective, right? You might have to lower your sale by 200 grand to get a hold and get it sold to the same prospective buyer from 2 years ago. Ouch, that's horrible. Now, factor in the fact that the Fed, at its last 4 meetings last year, hiked rates by 75, 75, 75, and 50 basis points consecutively. Now, we've only begun to feel the brunt of those hikes. My next guest is a keen real estate investor with his own projects currently in the works. Please welcome to the show, Jeff Sica. Jeff, thanks for being on. I thought that was a great article about really what these interest rate hikes are doing to the housing market, your purchasing power. Even if you're a seller, you have to take note, right?
Yeah, I mean, you brought up a lot of great points, Scott. I mean, first off, is when you have when you freeze a market, which is essentially what the Fed did, and by raising interest rates this much, and having where the sellers don't want to sell because they know they're going to have to find another place to live. They're also looking at the rents being significantly higher than they've been in probably in history. So when you have a residential real estate market that is not only being driven by low supply, even demand being still, considerable, but low supply, and knowing where a lot of that demand is coming from, Scott, is coming from the institutional buyers. Because what we have to remember is when the residential market crashed back in 2008, a lot of that buying was done by the Blackstones of the world, who bought, tens of thousands, if not hundreds of thousands of houses. So they're pulling supply off the market and keeping prices artificially elevated, which is problematic in and of itself.
Yeah, my producer talks about that all the time. And I mean, there is even a term, we spoke about it in the meeting this morning. There's a new term for a Nepo buyer or Nepo purchases, where people have to have some sort of nepotism, or some family members actually stump up the down payment for them because they just can't afford to get in the market. I know you've got kids. I mean, how does a young person even get on the ladder when you've got a situation where the sellers are not going to break down and lower their price, and buyers don't want to leave their 3.5% mortgage?
Exactly. I mean, and that's what to consider now, where you have these buyers coming into the market. First of all, they're saddled with student debt. I mean, I'm looking at, I saw some student debt interest rates. I mean, there's some private student debt that's up at 10 to 12%. I mean, to me, you leave college with all these expectations to buy a house, to live the American dream, and you're paying back these obscene college loans, and then you're expected to at some point buy a house, because that's the first thing I thought about when I left college, was that I wanted to buy a house. I wanted a place to call my own. Now you have everybody that's forced into, they've been starved out of the housing market. They're forced into the rental market. Inflation is bad across the board. Scott, I am so mad at this Fed. I am so unbelievably upset with what they've done. They have blood on their hands. They've created this inflation, and now they're trying to cover the scene of the crime by raising interest rates and crushing the housing market and breaking everything.
All right, and then they want to take credit for trying to fix it too, which it drives me crazy. It's like we've got a migrant problem in New York up by you, and everybody's sitting around about how we can throw money at the problem of what to do with all these migrants, where I would say we don't have to throw money at anything. We can just solve the problem by shutting the front door. But we don't want to, we don't want to make the easy decisions. We want to throw money at the bad decisions. I think the Fed did that with that transitory problem. I mean, the transitory is really why we got to where we're at, and combine that with the government spending as much money as they did, and we're in trouble.
Well, not only that, Scott, is that when you see they're raising interest rates, but they're not doing anything to increase productivity.
Right.
That's why when all this is said and done, Jerome Powell last week said that the increased interest rates might not have had the effect of inflation that people think. And now what you're dealing with is that they made these decisions to raise interest rates without looking at productivity. They created inflation. Now they're creating stagnant growth. Stagflation is the only thing I could think of that worries me more than inflation. And they've created a scenario where I don't see any other way that this is going to resolve itself. It's going to be there's going to be pockets of inflation. The consumer is going to continue to get annihilated. And then you're going to see stagflation and what we have in the housing market with low supply. I mean, if you look at the difference between pending sales and existing sales, you're seeing that the pipeline is not full enough to create a vibrant housing market.
Right.
So and then you're forcing them. We're in the apartment business, and you're forcing people to move into apartments and pay rents that are significantly higher than they might have even paid in a mortgage.
Right. Well,
in normal times.
Yeah, you got to jump. But you know what? You're right. And here's what I'm hearing from you. There's no way out. It's going to be whatever door you choose, it's going to hurt. And I think that's exactly right. Appreciate that, Jeff. That was awesome stuff. Thank you very much. Jeff Sica coming to us from Morristown, New Jersey. All right.